We're jumping straight into Nuburu today. Everyone is watching the price action, but the real story is their aggressive pivot into a defense tech hub.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And before we get moving, if you appreciate getting straight to the point, make sure to subscribe and hit the like button. Our goal here is simple. We simplify the complex financial data so you can make better decisions.
You know, we read the filings, so you don't have to.
We do. And today's topic, Nuburu, is just a perfect example of why you have to look past the surface.
It really is. If you just glance at the ticker, what do you see? You see a stock trading around, what, 17 cents as of late January 2026?
Yeah, it's down big.
It's down significantly over the last year. And, frankly, it looks like a lot of other penny stocks that have just sort of lost their way.
It looks like a disaster on the chart. If you just pull up the one-year view, I mean, it's a falling knife. But this is where it gets really interesting. This isn't just some random penny stock bouncing around. The company has fundamentally changed in, the last 7 days. We are talking about a complete identity shift here.
It really has.
Yeah.
For a long time, the market looked at Nuburu as a science project. And we see this a lot in deep tech, right?
All potential, no profit.
Exactly. They were a pre-revenue R&D company. They had some fascinating IP for sure, but they weren't an operational business. They were just burning cash to develop the tech, hoping the market would eventually catch up.
That's that classic Death Valley phase for a startup. You have the cool tech, you have the scientists, but you don't have customers actually writing checks.
But that phase, that science project phase, is officially over. They've moved into being an operational company. They completed the Lyocon acquisition. They've partnered with Techne. I mean, they're making moves that change the entire equation.
Okay, so let's unpack this. There's a lot to process.
We have to understand the foundation of why this is all happening right now.
Let's start with the bull case. If I'm an investor looking at this 17-cent stock, why am I excited? It starts with the moat, right? Their technology.
Yeah, the core tech.
They have this thing called high brightness blue laser technology. Now, I know laser sounds cool, but why does the color matter? Why blue?
Right. And to get why that matters, you have to understand a little bit of physics. Most industrial lasers, the ones cutting steel for cars or whatever, are infrared.
The industry standard.
And infrared is great for steel. But when you try to use it on shiny metals, we're talking copper, gold, aluminum, they really struggle.
Because it's shiny, right? The light just bounces off.
Exactly. It's the same reason you can see a reflection. The metal reflects the energy instead of absorbing it. So when you try to weld copy for, say, an EV battery, a huge chunk of that energy is just wasted.
So it's inefficient, you're blasting it with power, and the metal is basically just saying no thanks.
It's inefficient, and it leads to terrible quality. You get spatter, you get air bubbles in the weld. It's a mess.
Yeah.
And this is a huge problem because copper is the new oil.
It's in everything, every EV, every data center.
Every wind turbine, yeah. It's packed with copper. And that is where the blue laser comes in. Physics just dictates that blue light is absorbed by copper and gold much, much more efficiently than infrared. So instead of bouncing off, that energy goes into the material.
So Nuburu's tech lets manufacturers weld these key materials faster and with much higher quality. That's their edge.
That's the technological moat. They have the better mousetrap. But, like you said earlier, great tech doesn't automatically equal money.
Right. You can have the best laser in the world and you can still go broke.
And that's the catalyst here, the transformation of the Lyocon acquisition. This just closed, January 20th.
This is the pivot. Why does buying an Italian engineering firm change the story so much?
This is the game changer for their finances. Lyocon isn't some startup. They're an established engineering firm in Italy. By acquiring them, Nuburu isn't just buying patents. They're buying a functioning business.
A business
with existing customers, with manufacturing capacity, and with recurring revenue.
And that is the magic phrase right there. Recurring. Revenue. Nuburu is not pre-revenue anymore.
And it's not just the cash flow, which is vital. It's about credibility. Lyocon has a track record. They have customers. Nuburu can now funnel their blue laser tech through Lyocon's existing channels. It's like an instant distribution network.
Which lets them pivot to the next pillar of the bull case, the defense angle. This involves their strategic partnership with Techne, another Italian firm.
This part is wild. They basically bought a stake in a defense contractor, issued a convertible loan, And now they're moving toward taking a controlling interest. They're literally building a defense and security hub.
Okay, hold on. Let's clarify the structure. It's a bit complex. They didn't just buy Techne outright.
No, it's smarter than that. They issued a convertible loan. You can think of it like a try before you buy kind of deal. They lend money to Techne, and that loan can convert into ownership later.
So it gets their foot in the door without betting the whole farm on day one.
Exactly. But the goal is control. And the prize for that control is market access. Through Techne, Nuburu gets access to NATO contracts. They get access to the MENA-rated region, Middle East, North Africa, and APAC.
And these are markets that are incredibly hard to break into.
Oh, impossible. You can't just walk up to a Ministry of Defense and say, hey, buy my laser. You need partners who are already vetted and cleared. Techne is that partner.
So instead of trying to sell one laser at a time to a factory, they integrate their tech into huge defense systems that get sold to governments.
Correct. It's a dual-use strategy. The same laser that welds an EV battery can be used in defense manufacturing, and they now have the channel to sell into those massive government budgets.
But all this costs money. And Nuburu was, well, looking at their balance sheet from last year, they were basically broke.
They were certainly cash constrained. They were running on fumes. But that brings us to the financial fuel. On January 10th, they announced $23.25 million in financing.
That is a huge number for a company with a market cap this small. I mean, the company wasn't worth much more than the cash they just raised.
It's critical. That $23 million provides a runway. And in the turnaround game, cash is time. It gives them 12 to 24 months to actually execute this plan. It removes the immediate fear of running out of cash next month.
So if you put it all together, you've got superior tech, new revenue from Lyocon, access to NATO via Techne, and enough cash for maybe 2 years. If the market accepts this new defense tech story,
then the stock at 17 cents is priced for complete failure. A return to its 52-week high of 85 cents, that's a revaluation of what, around 380%? The upside is significant.
Okay, that sounds fantastic, almost too fantastic. Whenever I hear a story this good about a 17-cent stock, my alarm bells start ringing. Let's look at the flip side, because this sounds incredibly complex.
And when things are complex, things go wrong.
Exactly. What is the bear case here?
Well, the bear case is just as strong as the bull case, and it's probably why the stock is where it is. It starts with the most boring but most dangerous word in business: execution.
Execution. Easy to sign a deal, hard to make it work.
Especially when you look at the operational reality here. We dug into the filings. Nuburu lists a very, very small number of employees. We're talking around 8 people at the corporate level.
Wait, 8? 8 people? That's not a company. That's a dinner party.
It is a skeleton crew.
Huh.
And now think about what this tiny team is trying to do. They're trying to manage the integration of multiple Italian companies: Lyocon, Orbit, Techne. This is a complex roll-up strategy.
I can just see the risks. You have cultural differences, time zones. Italy is, what, 6 to 9 hours ahead? Different legal frameworks?
All of it. Imagine 8 people in the U.S. trying to coordinate with hundreds of engineers in Italy, merging accounting systems, supply chains, dealing with Italian labor laws. If there's a misalignment or if integration just gets bogged down, the whole thing stalls.
And a stall is fatal when you have their financial issues.
Absolutely. Let's talk about that financial health. The cash infusion is great, but the rearview mirror looks pretty ugly.
It does.
If you look at the trailing 12-month earnings, they show a loss of over $55 million.
Ouch. That is a heavy burn rate. That's over $1 million a week going out the door.
And the balance sheet shows negative equity. The debt-to-equity ratio is negative 60.8%. That means they owe more than they own. Technically, before this financing, they were completely underwater.
So even with that $23 million in the bank, the clock is ticking loudly.
Very loudly. If they don't get revenue from Lyocon flowing immediately, and I mean cash in the bank, not just invoices, they will burn through that new financing very, very quickly. They're in a race against their own burn rate.
And there's a third risk that scares me: government timing. We talked about how great the defense sector is, but the government isn't exactly known for speed.
You are right to be scared of that. Defense contracts are lucrative, but getting them is incredibly slow. And remember, they're moving to a controlling interest in Techne. That requires regulatory approvals. We're talking about an American company taking control of a foreign defense firm.
That sounds like a lot of paperwork, national security reviews.
It is. Italy has what's called the Golden Power Rule, which lets their government block foreign investment in strategic sectors like defense. The U.S. has CFIUS. If regulators on either side delay approvals by, say, 6 to 12 months, the whole 2026 revenue story just falls apart.
And suddenly that 2-year runway looks a lot shorter.
Exactly. And that's why the valuation is what it is. The PE ratio is extremely low, something like 0.04.
Which usually looks like a bargain. It usually screams, buy me.
But in this context, it just signals that the market expects these risks to materialize. It's cheap for a very good reason. The market is pricing in a high probability of failure.
Okay, so the picture is clear. High upside if they pull it off, massive risk if they get stuck in the mud. For the listener watching this, what are the specific things to watch for in the next, say, 30 to 60 days?
A few immediate triggers. First, keep an eye out for the Q4 earnings report, probably late February 2026.
What are we looking for there? The historical numbers will be a mess.
Yeah, the backward-looking numbers don't matter as much as the guidance. This is the first chance we'll get to hear management speak after all these deals. You need to listen for specific revenue guidance for 2026.
Right. If they're vague, that's a red
A
flag.
huge red flag. We want hard numbers. We expect X million from Lyocon in Q1. We want confidence. Beyond that, look for proof of concept.
What does that look like?
Press releases confirming revenue recognition from the Lyocon unit. The market needs proof that cash is actually hitting the bank accounts.
And what about that software piece, Orbit? We mentioned it but didn't dive in.
Right. Watch for news on the Orbit stake. Orbit is a SaaS platform. If they effectively take control, it adds a high-margin software revenue stream to the hardware business.
That would be a huge deal. Software margins are, what, 80, 90%? Manufacturing margins are not that.
Not even close. So if they can blend high-margin software with heavy hardware, the whole financial profile looks much better to Wall Street. It changes the multiple.
And finally, there's the macro factor. Defense spending cycles.
With global tensions, there's a huge demand for this dual-use technology.
Stuff that works for both EVs and tanks.
Exactly. The geopolitical landscape actually supports this. Governments want to onshore manufacturing and secure their supply chains. Nuburu is trying to position itself right in the middle of that narrative.
Okay, so let's give them the lowdown. What does this all mean?
The summary is this. Nuburu is a high-risk, high-reward turnaround play. You're betting that a tiny team can successfully combine superior laser tech with Italian manufacturing and defense contracts.
It's a bet on the jockey, not just the horse. Can this management team juggle 3 acquisitions at once with, like, 8 people?
If they execute, the current valuation is capitulation pricing. It's rock bottom. If they stumble on the integration, the cash burn is the enemy. It's a classic binary outcome.
Here's a final provocative thought for you to take away. Is Nuburu a laser company trying to do defense, or is it becoming a defense holding company that happens to be fueled by laser tech? The answer to that question determines if this is a quick trade or a long-term hold.
That is the question to ask. If they're a holding company, the laser is just a tool. If they're a laser company, the defense contracts are just a sales channel. It changes how you value them entirely.
Thanks for listening to the Easy Money Show. Subscribe and simplify.